Tony, the market has come a long way since last year's value rally. Is this greed? Is this investors in a deep slumber, given the VIX was at its lowest rate last Friday during the pandemic? And should we be fearful? What do you think?
Well, I have to start with a caveat. If you know anything about Harris Associates, you know that everything we do is bottoms up, company by company. And so I'm not going to be that intelligent on the overall market and where it's going. I think the deeper question you're asking here is, we've had a great value rally. How much more is there to go? And you're kind of asking indirectly about market risk. And has the market run so far that we should be worried about a drawdown or something like that? Okay. So with the caveat in mind that I'm a micro, not macro guy, I'll give you some of my thoughts. First, as for the market, I view market risk as proportional to price. Okay, valuations are above normal today, so your expectations for future returns could be below normal. Right, price is above normal, future returns below normal. What that means for the next 3, 5, 6 months, week, whatever, I have no idea. Okay, but when valuations are high, you should have lower expectations for returns. When you're looking at value managers, one thing to keep in mind, and this is really the silver lining in this market, is that dispersions determine, and the direction of those dispersions determine how value managers do on a relative basis. Almost a year ago, we were at near record all-time dispersions, which means the highest price stocks, the difference between the highest prices and the lowest prices was as wide as we've seen since the late 90s. And that has come in some as value has rallied and the markets have rallied, but it's still 2 standard deviations above normal. And we know how markets work. They go above normal and then they go below normal. And as those dispersions come in, value managers tend to do very, very well. And we've benefited from that. But if you look at the dispersion numbers, it looks like we're maybe halfway through the game. And if you look at history, the value rally has been something like 8 months. Typically, they run 30, 35 months. And so, that's one measure. I don't think it's very useful, but that's one thing to keep in mind. Another one is if you look at values outperformance by 20 percentage points, that's only a third of its normal correction of 60 percentage points, not basis points, percentage points. So those 2 historical metrics tell you we're something like a third the way through. The dispersion numbers tell you we're somewhere like half the way through. And the punchline is, I don't know, Will doesn't know, nobody knows, but these are our best guesses.
Okay, well, interesting. So focus on companies and see what they're doing.
Exactly.
So as a bottom-up, thinking about that actually, as a bottom-up stock picker, how do you think about the changing economic cycle versus the business valuation?
Yeah, when your time horizon expands, like ours does, decades if necessary, we are looking at intrinsic value. And when you do that, you're taking the present value of future cash flows. So what you're doing is you're estimating business value, and you're not guessing stock prices based on macro factors or what the next quarter looks like. And so when you're estimating business values, the key thing to get right is, what do the next 10, 20 years of cash flows look like on average? And businesses have ups and businesses have downs, right? Manufacturers, they're sensitive to GDP. Banks are sensitive to interest rates and credit losses. And so every business kind of ebbs and flows. And as a value manager, it's really important that you smooth that out. So when you look at the cash flows, we adjust for the ups and we adjust for the downs, and we estimate the per share value accordingly. And what happens in the market is that, I think the market gets a little excited when things are really, really good, and it gets awfully pessimistic when things are really, really bad fundamentally. And why does it do that? If you look at the average institutional portfolio, the turnover is over 100%. What does that tell you? Their time horizon is less than a year. Your time horizon is less than a year, you are trading stocks based on maybe a year's outlook or something like that, rather than what the next 10 or 20 years look like. And so when the market gets too excited or too pessimistic, Harris Associates steps in. We're either selling the stocks or we're buying the stocks, depending on whether they meet our criteria or not, as the market fails to adjust for these sorts of ups and downs.
So thinking about that in taking that further on, what's your holding period, your average holding period? And does that change during time of volatility?
Yeah. Well, I wish it was shorter, but it's longer because it takes time for value to adjust. The market has to come to terms with what we think business value is. And that, assuming we do our work right, that does not happen overnight usually. And we wish it did. But like I think Warren Buffett said, right, the market's a weighing machine in the long term, a voting machine in the short term. And it takes a while for that weighing machine to work. And so the turnover on our portfolio is anywhere from 25 to 35%, sometimes a little higher, sometimes a little lower, depending on the product and the year and the amount of volatility. You can imagine if you are an intrinsic value investor, the more volatility there is in the market, the more stock prices are moving around, the wider the gaps are moving around relative to business value. And so we're going to be more active. And when there's less volatility, there's less to do. And we're happy to do nothing if there's nothing to do.
So value, it's interesting you mentioned intrinsic because value style is a broad church. You have both intrinsic and relative. Can you talk between the two and why you think one is better than the other and how it performs over time?
Yeah, and look, my comments, this is not meant to be a criticism. There's many ways to make money in the markets, okay, and relative value might be one of them. The way I think about it is, if you're doing relative value, it's most useful in a long-short format. Now, we don't short stocks at Harris Associates, so we aren't playing one off of another based on a relative valuation metric. So when you're an intrinsic value investor, what you're doing is you're looking at the future cash flows, you're discounting those back, and you're buying them when it's at a discount for us. Now, we demand a very significant discount of at least 30%. Okay, and the reason we've elected to go intrinsic is if you just look at the stated financials, which is what relative and statistical value sort of force you to do, you can be missing something. Companies could be making an investment on the income statement. They could be going through a cyclical downturn. There can be things masking the underlying value of the business, and it can work in reverse. The company could be way over earning what its next 10 years are likely to look like because it's in a great environment. And if you just look at relative value, you might miss what's going on underneath the covers. You also might miss the quality of the business. Just in simplistic terms, at Harris Associates, we believe, let's just say there was a company at 15 times cash flows that we think is worth 25 times given the growth and quality of the business. Well, that's cheaper than a company at 10 times earnings that's worth 12, right? Now, from a relative value standpoint, you'd say, well, maybe I'd lean towards the 10 times earnings company, but if it's only worth 12, that's not a lot of upside. And you're missing something when you're not comparing it to a higher quality business that's worth even more. And so what we've focused in on intrinsic value. It's been working for us, but there's many ways to skin a cat.
You get close to management teams. How many meetings, as an active manager who's engaged with management teams, how many meetings do you do a year with those teams?
Yeah, well, it's well into the hundreds, if not thousands a year, depending on whether we're in a pandemic or not. And when we're in a pandemic, we're still doing Zoom. But it's not what it is when you're sitting across the table from somebody. So we're looking forward to that.
Yeah, absolutely. And if we're thinking about management teams and their approach to the businesses, we're starting to move into governance, obviously, which you've mentioned, and that brings in the topic of ESG and sustainability. Yeah. It has been discussed, or broadly in the industry, can value managers really do ESG? So what's your opinion, what's your approach, and how have you thought about that?
Well, I'll give you the way we think about it at Harris. So, and we do think about ESG just for starters. And for 45 years since we've been in existence, the G part has been a fundamental aspect of our process from the beginning. And we believe that governance informs the E and the S and how companies, act, whether it's responsible and sustainable in those areas. The governance is really going to determine that, because these are the decision makers making the decisions. The management team, the board, they make decisions about how they act as an environmental, on how they impact the environment, depending on the industry that they're in and how responsible they are. When it comes to how they treat employees or social elements, or how they they act in their communities. The management team and the governance really is driving that. And we've been imposing our view of what good governance is on our clients for 45 years. And we are going to continue to do that. So that's the G. The E and the S, this is where there's a lot of gray. And Harris is not going to impose, and Tony Canaris is not going to impose my personal views on you, the client, on E and S. What we will demand is that our analysts price for the risks, and that the companies have a sustainable approach, a good global citizen approach to those.
So when do you expect corporate profits to peak?
Yeah, we don't make that sort of assumption at Harris. What we spend our time on is figuring out, like I said, what the average of the next 10 years is going to look like. And so what we'll do is, rather than focus on when's the peak, when's the trough, we take the current environment and the current realities, and then we figure out what's the path to normal from here. Is it up or is it down? And then time weight the cash flows over time for what the business is likely to do based on the history of ups and downs in the business. And so I don't really have a useful macro forecast on when the peak is, and I'm not sure that anybody does.
Tony, thank you very much indeed for your time. It's been fascinating. We look forward to continuing on the value journey with Harris Associates.
Thanks, Will. Thank you, everybody.